The Indian rupee has fallen to fresh record lows repeatedly in recent months. And if the rupee continues to depreciate against the US dollar, India may take longer to become the world's third largest economy.
The reason the global economic size measure is listed in dollars and a weaker rupee would mean the exchange rate would offset the growth in India's output. Well, in this next report, we break down the rupee's journey since India opened up its economy in early 1990s. Take a look.
India is the fastest growing major economy. Still, the rupee has weakened significantly against the dollar. The real question is why? To understand this, one needs to look at the 3-decade journey of the Indian rupee against the US greenback. From 17 rupees per dollar in 1990 to 89 rupees in 2025, the long-term trend shows global macroeconomic changes, inflation, trade balances, and capital flows. Currencies don't move overnight. They move in response to economic trends and inflation expectations. Understanding this helps investors make better long-term decisions. By 1991, due to a severe balance of payments crisis, India undertook economic liberalization. That included a significant devaluation of the rupee to about 17.9 rupees per dollar. This change marked a shift to a more market-determined exchange rate system. The correction reflects economic reform like tariff reductions and encouragement of foreign investment that was driven by persistent inflation, large trade deficits and rising import costs such as crude oil. Inflation differentials have played a major role in rupee value. When India's inflation has been higher than that in the US, it eroded the rupee's purchasing power. The reason? One needed more rupees to buy a dollar. This persistent inflation contributed to long-term depreciation against the dollar. Other key factors impacting the currency include India's trade deficit, rising oil prices, foreign institutional investor flows, and US interest rate changes. India is particularly sensitive to international crude prices as the country imports over 85% of its oil needs and is the world's second largest consumer. Also, trade deficits increase demand for dollars to pay for imports, putting pressure on the rupee. By 2025, the exchange rate has weakened to fresh all-time lows of around 88 to 89 rupees per dollar. Short-term fluctuations are also driven by capital flows and global economic events. But currency changes mainly follow economic fundamentals over time. Therefore, India's progress towards becoming the world's third largest economy could be hindered if the rupee keeps losing value against the dollar. Business Bureau WION, World is One.